Welcome to the Me the Money Show. I'm Dan Barnes, editorial director at Markets Media Europe, and joining me today is Lynn Strongin Dodds, editor of Best Execution. Lynn, welcome to the Me the Money Show.
Thank you, Dan.
Thanks for having me. What stories have you been working on this week?
I've been working on three, I think, major stories. The first story is about the Boston Consulting Group, which published a report on the Global Asset Management 2020 Protect, Adapt, and Innovate. I've been also working on the lifting of the ban of short selling across the EU, and finally on market surveillance and the issues that has caused from everyone working from home in the financial service industry.
Very good. Tell us a bit more about the BCG report.
Well, it's really, it was interesting because it was written before COVID and then kind of configured during COVID. And what it says is that the state of asset managers, they really need to profoundly change their operating models, basically, if they want to stay in the game. And when they were writing it at the end of 2019, Europe had record inflows. Europe is the second largest region by assets, and AUM jumped by 13% to 22.8 trillion. And in the UK, which is Europe's biggest market, accounting for about a third of assets under management, they had an expansion of 13% despite Brexit uncertainty. But the gains were wiped out in March when the markets were the most volatile, and European money managers, suffered outflows equal to 3.1% of AUM, as much as the previous 9 months combined. So that was quite a dramatic impact. And the author, Lubasha Haridia, the partner, as well as the author, said that what's happened is only intensified the industry's challenges, and asset managers find themselves in completely uncharted territory. And if you compare it to the crash of 2008, everyone was saying, "Oh my goodness, the asset management industry is going to really suffer." But in fact, they've benefited from a market rebound that produced the longest bull market in history. This is not going to be the case in 2020. And firms are going to have to recover flows and profitability through much more fundamental changes in their business models. And if you look at it, that really translates into not only refocusing their product portfolio, but also shaking up their cost structures and investing in innovative technologies. Now, you might say this can seem obvious, but funnily enough, these investments are reduced in downturns. If they do it this time, it will be really dangerous. Information, of course, will be at the heart of these strategies. And what the report says, companies should really build better data science capabilities that gather, clean, synthesize, and visualize vast amounts of client information and provide meaningful insights. The report also envisions much stronger distribution channels, greater M&A, which is no surprise, and strategic alliances. And it kind of envisions a reshaped operating model where you also have insurance partners and their distribution networks, and that's going to be a standardized, fully digitized ecosystem. And finally, what was interesting about the report is, and not, again, surprising, is that fund managers are really going to have to create much more bespoke services and, of course, incorporate ESG, which was gaining momentum before COVID, but has really accelerated because the funds more or less have done better than their mainstream forms. So in the past, ESG analysis was like a nice feature, and today it's really a must-have if asset managers want to remain competitive.
That's great. Well, thanks very much for that. So then going on to the short selling ban, obviously you saw a number of European countries ban short selling. That's always a controversial thing to do, has a potential impact on liquidity because hedge funds who are short selling are of course buying at the point where everybody else is selling. So it provides liquidity into the market somewhat, but can accelerate movements. What was the story from as this ban was lifted?
Well, as you said, there's a lot of debate and discussion as to whether regulators should have implemented these things in the first place and introduced during the extreme volatility in March when the national lockdowns were rolled out, across Europe to stem the pandemic. This week, I think I would say there was a collective cheer in the financial service community when the European Securities and Markets Authority, or ESMA, announced that the regulators in Austria, Belgium, Greece, France, Spain, Italy jointly decided to lift these bans. Italy actually had expected to have been a holdout and wait until mid-June, but the country decided at the last minute to align itself with the other 5 EU states. And the UK and Germany did not have sanctions, so they weren't included in this group. Now, trade groups had been calling for this for weeks. And even last week, you had people like the Alternative Investment Management Association, the FIA, the World Federation of Exchanges were really chomping at the bit and saying you need to lift this. And their argument was that over the long term, the ban not only hurts liquidity, and undermines confidence in key European financial markets, but they were very worried about the problems it would pose to the capital markets union, which has been going on for years. But the aim is to further integrate the capital markets across the EU, and they are hoping that this will be vital to European recovery from the profound economic impact that everyone's suffering. So analysts at Barclays said that the move to lift the ban should not reintroduce volatility. They looked at short selling bans during the global financial crisis and found that European stock rallied after their removal. But, I mean, the caveat is they're saying, analysts said that as long as fundamentals improve, short selling should not be a problem to further recovery to equity markets. But I think the real question is, will fundamentals improve? And I think the jury is out on that.
Yeah, no, that's a really good point. And then finally, you mentioned market surveillance. Obviously, as you said, with people working from home and operational workflows in terms of on-site operational workflows being disrupted, you can see that people might be concerned about market activity and the ability to survey that.
Well, Greenwich Associates came out with this report, Protecting Market Integrity During High-Risk Conditions. And actually, they showed that trade surveillance alert volumes soared a staggering 874% from January throughout March in some of the American-based sell-side firms. It wasn't as spectacular, but still high, 636% in EMEA region and 675% in Asia-Pacific. Now, I mean, no one was surprised that there were so many red flags because, as we've said before, March was really volatile, and this created several abnormal trading patterns. But the author, Danielle Tierney, said that, for market surveillance and trade compliance infrastructures, these conditions quickly proved and actually are still proving to be the ultimate stress test. And their recommendation was that firms need to up their investment in technology. Now, this might be seen as a given because investments annually were typically 10% every year for the past decade. But surveillance systems were not seen as a high priority on the IT budget. I think, though, lessons are going to be learned and continue to be learned because the firms that actually weathered this peak volatility and had the least trade breaks were those that had high-quality surveillance technology. But that wasn't the only thing they had. They actually adopted a much more holistic approach to data source inputs. And equally important, and often sometimes forgotten, they had very good people on the ground that could actually handle these tools. And the Greenwich report said that these three things combined will actually help firms going forward.
And I'm interested in that figure about the very high percentage of reports being treated between January and March. Is that inclusive of that quarter? So is that potentially all largely coming from the very volatile period we had in March?
Yes, the report said that most of the high volatility was in March.
And so do they have a correlation with potential misbehavior, or do they seem to draw any conclusions about whether that's simply false flags for the...
That's it. I think they have a conclusion that you can't really tell if it was misbehavior. Now, you have other regulators actually looking at misbehavior in a much more detailed way. I think what Greenwich was looking at was actually the red alerts, but no one was kind of qualifying what these alerts actually were. But the trading patterns were so abnormal that kind of, raised all these red flags.
That's great. Lynn, that's been excellent. Thank you.
Thanks very much, Dan, and take care.